Hello, everybody. My name is Yaman Tashtavar, and I bring you daily updates on Tesla, tech, and the markets. Welcome to Tesla Live. Let's get started right away. We have a lot to cover today. Markets are mostly flat today. Advancing issues are above declining issues by 57% to 39%. 497 stocks are making new highs as opposed to 59 stocks that are making new lows. In the last hour or so, markets have moved up a little bit. You can see the most traded stocks: Nvidia, Tesla, CrowdStrike, which announced earnings down 6%. You can see that the yields, 5-year, 10-year, 30-year treasury yields are down double digits, 10 basis points, 11 basis points across the curve. And we're going to get into why that is. Crude oil is $63 per barrel. Heat map. You can see the Max 7 are mixed except for Tesla, that's down 3.5%. Energy stocks are down as well. Everything else is pretty much mixed. Let's continue with our daily article. Wall Street climbs as tech boost offsets economic worries. US stocks edged higher on Wednesday as strength in technology shares offset decline driven by weak economic data that deepened concerns about the impact of the Trump administration erratic trade policies. Give me 1 second. Let me just make sure everything's fine. Good. The services sector contracted for the first time in nearly a year in May, while businesses paid higher input prices. So, this is a really important part right here. The services sector contracted for the first time in nearly a year in May. So, this is after Trump pulled back a little bit on his excessive tariffs and markets surged, and still we saw the services sector contract. And on top of that, they paid higher input prices, which is a recipe for stagflation. A reminder that the economy was still at risk of experiencing a period of very slow growth and high inflation. And on top of that, the ADP National Employment Report showed US private employers added the fewest number of workers in more than 2 years in May. On Friday, we're going to get the more important non-farm payrolls data. We're going to dig into that as well. This is going to be a macro heavy episode, and then later in the episode, we're going to dig into automotive industry and Tesla. Washington doubled tariffs on imported steel and aluminum to 50% on Wednesday, the same deadline President Trump had set for trading partners to make their best offers to avoid other punishing import levies from taking effect in early July. Investor focus is squarely on tariff negotiations between Washington and its trading partners, with Trump and Xi expected to speak sometime this week as tensions simmer between the world's two biggest economies. If we can get to an agreement on China, the tariff battle will be a headline issue for months to come and will have an impact on both domestic and international economies, said Phil Blancato, CEO of Landenberg Thalmann Asset Management. May was the best month for the S&P 500 index and the tech-heavy Nasdaq since November 2023, thanks to a softening of Trump's harsh trade stance and upbeat earnings reports. S&P is just a couple percent away from record highs. Barclays joined a slew of other brokers raising its year-end target. Okay, shares of 6 of the 11 we talked about that. Shares of Hewlett Packard rose 2% as demand for the company's AI servers and hybrid cloud segments helped it beat estimates for the second quarter revenue and profit. Global Foundries rose 2% after the chip manufacturer announced plans to increase its investments to $16 billion. We're going to dig into that a little bit. Tesla dropped 3%. We're going to dig into Tesla later. And we talked about that. Dollar Tree fell 7.5% as the discount store operator forecast second quarter adjusted profit could fall as much as 50% from a year ago due to tariff driven volatility. I think this is an important piece of information, and we might dig into that later on. Let's continue. In the meantime, please take a moment to like, subscribe, and repost this live stream. We're growing at a very nice pace. Yesterday, we had thousands of people listen to the episode, And let's see if we can grow that today. Global Foundries boost investment plans to $16 billion with research focus. Chip manufacturer Global Foundries said on Wednesday it planned to increase its investment plans to $16 billion, allocating an additional $1 billion to capital spending and $3 billion to research in several emerging chip technologies. The Malta and New York-based company said it is working with the Trump administration to bring chip manufacturing technology and various components of that supply chain onto U.S. soil. The chip manufacturer attributed the expansion to the boom in AI, a trend that has also benefited other chip makers such as TSMC. The $1 billion capital spending boost is expected to support factory expansions in New York and Vermont, and its addition to the $12 billion company said in 2024 it plans to invest. So I've been actually following this space quite a bit, especially CapEx investments, new factories being built, AI factories. And there is dramatic slowdown in hiring for related positions in this space over the last year. I'm not sure when these factories are going to, when these CapEx will be spent, when the factories will come online. But my understanding is that there is some limitations, physical limitations, that this can't happen in the near future. So it may take several years for this investment to start generating revenue and profits for the companies, and something to keep in mind. The $3 billion R&D Global Foundries say it will be split into three areas: chip packaging technologies, silicon photonics that can be used to make quantum computing processors, and gallium nitride, which is used in EVs and other power-related applications. All right, let's move on. So this was a pretty critical piece of information today. Very critical piece of information. ADP report, job gains came in much lower than expected in May, on top of a weak April. So let's dig into the data. US private payrolls post smallest gain in over 2 years in May. US private employers added the fewest number of workers in more than 2 years in May, but the data is probably not a true reflection of the labor market, which is gradually easing amid economic uncertainty over the Trump administration tariffs. I'm not sure what justification they have for this part of the sentence, but let's continue to see if we can gain more information from the article. Private payrolls increased by only 30,000 jobs last month, the smallest gain since March of 2023, after a downwardly revised rise of 60,000 in April. So that's back-to-back months of below what is necessary to keep the unemployment rate at about 4.2%. And I think it will continue to weaken, because if we dig into detail, as we will in a second, I'll show you why. The ADP National Employment Report showed on Wednesday. Economists polled by Reuters had forecasted 110,000 following a previously reported increase of 62,000 in April. So 1/3 of what was expected. The ADP report, jointly developed with the Stanford Digital Economy Lab, was published ahead of the more comprehensive employment report for May that is due to be released on Friday by the Labor Department's Bureau of Labor Statistics. There is no correlation between the ADP and BLS employment report. I think that's BS. This right here, I think is BS. But it depends on how you look at it. Okay. Government data on Tuesday showed there were 1.03 job openings for every unemployment person in April, little change from March. As usual, we suggest ignoring the message from the ADP employment report, mostly because it has a very poor record in recent years, said Oliver Allen, senior economist at Pantheon Macroeconomics. The services sector accounted for nearly all of the new jobs last month, with payrolls in that category rising by 36,000, which is anemic. That reflected gains in the financial activities, information, as well as leisure and hospitality. Goods producing sectors declined by 2,000. They didn't dig into the most important stuff, so let's do it ourselves. Let me just make sure. Any questions, comments? Oh, wow, Zachary, just on YouTube, Zachary posted $5 tip right here. Keep up the great job. Thank you for everything you do. Thank you very much, Zachary. I appreciate that. You can send a super chat on YouTube, and you can send a tip on X if you want to see more episodes like this one. Thank you, Zachary. Let's continue with some details. ADP National Employment Report. I know this stuff is boring, but this is actually pretty important. Um, Private sector employment increased by 37,000 jobs in May. Annual pay was up 4.5%. So one thing here is that one thing to notice, this is anemic. This is not going to sustain the economy. The unemployment rate will continue to rise if this continues, which I think it will. Okay. Even if it's positive, even if it's very low, this is not enough to sustain the unemployment rate at 4.2%. You need something about 100 to 150,000 per month of jobs. Annual pay was up. So despite that, the wage growth is actually pretty high. And the Fed wants the wage growth at a sustainable level, which is more around 3.5%. So to 3.5% wage growth is what is sustainable with 2% inflation rate, and 4.5 is actually pretty high. So uh, private sector employment increased by 37,000. I'm going to scroll through this. You can read, pause the video and read if you wish to. Um, but I want to highlight 14.8 million individual pay changes observations each month. So the the number of data, the level of data they use to produce this report is actually very high. And I believe their chief economist goes on CNBC to talk about the data a little bit more. She has an interview up today, actually. You can find it on YouTube if you wish. And she's very knowledgeable. I mean, if you listen to her, you'll see, I think this might be her, Dr. Neela Richardson, um, chief economist at ADP. Is very good and very insightful. I highly recommend listen to the interview when you get a chance. And you'll see that ADP report is not as useless as people make it out to be, as we just read in the Reuters article. A lot of people think that this report is useless, but it's not likely. Kind of just have to zoom out. Like you have to be able to zoom in and zoom out to kind of like know what you're looking for to make sense of this data. After a strong start to the year, hiring is losing momentum, said Dr. Neil Richardson. Pay growth, however, was little changed in May, holding at robust levels for both job stayers and job changers. Okay, so a couple of insights here. You can see that we didn't get from the Reuters article, kind of shockingly, actually. Goods producing data is negative. Okay, so goods producing sectors lost employment. But look at construction. Construction is up 6,000. Okay, so despite construction being up 6,000, goods producing data is down 2,000. I think this is going to change into negative as well. So I would expect goods producing jobs to turn even more negative throughout the rest of the year for various reasons that we've discussed before. Um, if you want more information, you can dig into the YouTube shorts and find the ones about construction industry, and you'll get more information there. Service providing jobs were up 36,000. Okay, financial activities up 20,000. So financial activities are carrying up because in May, we saw a tremendous surge, a V-shaped recovery in the stock markets. If the market peaks and starts declining, you're going to see this number decline pretty fast. Okay, and we've already seen some layoffs from Microsoft, for example, in the information sector in recent days. So this might also turn negative. So this is like these wrong industries, like the industry that I think will turn negative are carry this number in May. Okay. Leisure hospitality, 38,000 plus 38,000. We know that baby boomers are still traveling. They don't have any mortgages on their house. Their houses are paid off. They benefit from high interest rates. So baby boomers, a large cohort of the population, is kind of carrying this sector right here. But for how long, that remains to be seen. Some variability in regions, you can look at that on your own. But what I want to highlight here is also small establishments. Okay, so these are employers with less than 50 employees, down 13%. And here's an interesting fact that the chief economist shared. 70% of employment in the US comes from small establishments. 70%. So if they are already weakened and they're losing jobs, it's not going to get much better for them from here on out. The Fed rate stays high, it remain high. Even the 10-year 25-year, 10-year yields, treasury yields are high, and the credit spreads are very low, historically low. And I think they're going to widen. And we have hundreds of billions, if not trillions of dollars of debt that needs to be refinanced in the next couple of years. I don't think it's going to get much better for small establishments from here on out. Okay. I noticed that they have pay for job changes rose 7%. I think this might be a fluke. I think this might. I think this is going to reverse next month. I noticed job changes are a little higher than job stayers, but how many people change jobs? I don't think this is a very statistically robust figure. So I suspect that it's going to drop pretty substantially next month. All right, and you can see here that really all of the numbers revolve around 4.5%, depending on the industry. Okay, let's move on. Doubled US tariffs. Any questions, comments you can leave in the chat. Doubled US tariffs on steel, aluminum kick in. Whoops. Kick in as deadline for best offers hits. And that's how you know this is live. The United States and European Union said trade talks advanced quickly and in the right direction on Wednesday. Top negotiators said, despite the stumbling block posed by new U.S. metal tariffs, the President Trump's doubling of tariffs on steel and aluminum imports kicked in on Wednesday, the same day his administration sought best offers from trading partners to avoid other punishing import levies from taking effect in July. Steel tariffs are very important. Aluminum tariffs are also very important. For inflation. So we'll see how this shapes up. The 27 nation EU's trade negotiator and US trade representatives said their meeting in Paris was constructive. We both concluded that we are advancing in the right direction at pace. Okay. Talks have advanced very quickly. Let me skim through this to see if there's anything useful here. The Republican president has long been angered by the massive federal trade deficit. We know all that. However, nonpartisan congressional budget officer said Wednesday that U.S. economic outlook will fall as a result of Trump's new tariffs on foreign goods that were in place as of May 13. Okay. In another sign of disruptions to global trade, concerns about damage from China's restrictions on critical mineral exports. This is very important. This is very important. If you have not read about rare earths and how dominant China is in heavy rare earths, I think they refine 98% of heavy rare earths, which are critical for EV production, not only EV production, but also for gasoline car production and many other industries such as MRIs. This is a very significant card that China is going to play in these negotiations. So if you haven't looked into this topic, you should definitely look into it. You can go into my YouTube shorts to pick the ones that talk about this issue. With some European auto parts plants suspending output, okay, and I think Tesla is at the risk of this as well. The European auto parts plant suspending output and German car maker BMW warning that the supplier network was affected by shortages of rare earths. Okay, so this can impact Tesla's. I know many of my viewers are Tesla investors. This can impact Tesla's production in China, Europe, and US. Separately, Trump said early on Wednesday that Chinese President Xi Jinping is tough and extremely hard to make a deal with, etc. I think there's going to be a call on this at some point. The expected hike in levies jolted the market for both metals this week, especially for aluminum, which has seen price premiums more than double. So aluminum domestically, my understanding is that there's not much excess production capacity, whereas in steel there is some. So that may be why we're seeing aluminum prices double, but steel prices not get as impacted as much. Late on Tuesday, Trump signed an executive proclamation on a hike in the tariffs on imported steel and aluminum to 50% from 25% rate introduced in March. The increase came into effect at 12:01 a.m. on Wednesday. It applies to all trading partners except Britain, the only country so far to strike a preliminary trade agreement with the US during a 90-day pause on a wider array of Trump tariffs. A steel coil is moved, etc. The picture. Sef- Sefcovic said he deeply regretted the doubling of the steel tariffs, stressing that the EU has the same challenge over capacity as the US on steel, and that they should work together on that. About a quarter of all steel used in the US is imported, and Census Bureau data shows that increased levies will hit the closest US trading partners, Canada and Mexico, especially hard. Canadian Prime Minister Mark Carney said intensive negotiations continued on Wednesday on the new US tariffs, which he considers illegal. Canada is even more exposed to aluminum levies as the top exporter to the US, by far at roughly twice the rest of the top 10 exporters' volumes combined. The US gets about half of its aluminum from foreign sources. Global forex, bond, and stock markets took the latest tariffs in their stride, etc. Uncertainty around US trade policies created havoc. Aluminum Association urged Trump administration to reserve high tariffs for bad actions, including China, and include carve-outs for partners like Canada. New tariffs will affect everything from autos to aircraft to aluminum beer containers, oh God, to cans for processed goods to machinery and equipment, said Georgetown University professor, a trade policy expert. It's hard to imagine that won't be impacted in the terms of manufacturing industries. Yeah. Um, that's all for due date. We talked about that. Okay, let's move on. This one was a shocker this morning. So let's see if we can dig into data. A lot of times you see the headlines not doing justice to the data that's coming out. So let's see if we can dig into a little bit more here. This is the source. We go into the source for the data. Services PMI at 49.9%. So this is just below the 50 level. It's turned contractionary. Services have been keeping the economy going for the last couple of years, even as goods manufacturing started slowing down much earlier and a much deeper pace. Services PMI is also now negative. May 2025 services PMI report. Okay. Business activity at 50%, but new orders index, which can be predictive sometimes, at 46%. Okay. Employment index at 50.7, 51%. Supply deliveries index at 52.5. Economic activity in the services sector contracted in May, the first time since June 2024, state the nation's purchasing and supply executives in the latest report. Below the 50% break-even point for only the fourth time in 60 months since recovery from the coronavirus pandemic-induced recession began in June 2020. All right, so it's very material. Give me one sec. We talked about the breakdown of that. And this is first month out of expansion territory since 2020. Business activity index unchanged. Okay. New orders index dropped into contraction territory in May, recording a reading of 46.4%, a decrease of 5.9 percentage points from April figure. So that's a very dramatic slowdown in 1 month from April to May, even as the stock market surged. Employment index returned to expansion after 2 months of contraction. Okay. Supply deliveries index registered 52.5%. 1.2 percentage points higher than the 51.3% recorded in April. This is the sixth consecutive month that the index has been in expansion territory, indicating lower supplier delivery performance. Okay. Now, this is the critical part that I don't think many people are paying attention to. Okay, this part right here. The prices index registered 58.7%. So that's extremely high, from rising from already very high level in April. Okay. Prices index registered 69% in May, a 3.6 percentage point increase from April's reading of 65.1%. The index has elevated 7.8 percentage points in the last 2 months to reach its highest reading since November 2022. This is the first time the index has recorded its high of 2-month increase since the 9.2 percentage point index in February and March of 2021. So these levels are at levels where people really used to be concerned about hyperinflation. And again, in May, the stock markets were surging. We had already, Trump had walked back most of the tariff increases. And despite that, prices paid has stayed high in May. So I suspect starting in June, we're going to see higher CPI and PPI numbers that is going to be worrisome to the Fed. The inventories index returned to contraction territory in May, registering 49.7%, a decrease of 3.7 percent points from April's figure of 53.4. Okay. Backlog of orders increased, registered 43.4 percentage points in May. So that's deep in the contraction territory. A major drop from the April figure of 48%, which was already contraction, indicating contraction for the ninth time in the last 10 months and its lowest reading since August 2023. There's some industry data here. They talk about new construction. You can pause the video and read about it. I need to move a little bit because we have a lot to cover today. And there's some, what I really like about this report is that there's some anecdotal evidence provided from different industries as well. So let's look at construction, which is a macroeconomically very important industry, especially single family construction. Tariff variability has thrown residential construction supply chains into chaos. Many items are still manufactured in Southeast Asia, and suppliers are beginning to test the waters for increases. Major heating, ventilation, and air conditioning equipment manufacturers are passing on their cost increases due to higher refrigerant and steel commodity prices. Planning is difficult for community projects that could be scheduled for the next 22 to 30 months. Okay. On healthcare, which has been a strong part of the economy, and social assistance. Check this out. Federal budget cuts are affecting purchasing decisions. I think this is way more widespread than people realize across healthcare and social assistance. Let's um, let's move on. Nick Timiraos shows that prices paid rose to 2.5-year high and new orders fell 2.5-year low. Now the combination is what's extremely worrisome here. Look at this graph. Okay, look at this graph. ISM non-manufacturing indices seasonally adjusted. The light blue line is prices paid index. The dark blue line is the new orders index. This is stagflation right here. Okay, this part shows stagflation. The dark blue line plunging into almost recessionary levels here. Okay, 2001 recession, the Great Recession, and COVID. All right. But unlike many of these periods, the light blue line is surging. All right. And that really only has happened over here. And I'm going to scroll up a little bit so you can see the CE years a little bit more. Over here in 2008, when oil prices were surging and the economy had already entered the recession at the beginning of 2008. Okay. And it got worse and worse and worse throughout the year. So I wonder if we're going to see something similar throughout the rest of this year and next year until something major changes. Okay. They say Trump always chickens out, Taco, but we'll see if he chickens out on some of these things. Let me know what you think in the comments below the video. Liz Ann Saunders also shows, ouch, May ISM services PMI down. You can see different components on the graphic here. Okay, you can pause the video to check it out if you wish to. Now, more concerning information from the New York Fed survey, one of the more important regional feds. Most firms pass through to customers at least some of the tariffs, as we would expect. 3/4 of factory firms, service firms passed on some amount of tariffs. Switching to domestic sources may have blunted some of tariff increase. Okay. as we would expect, as economics would dictate, but unlike what some people claim. Economists raise questions about the quality of US inflation data. Just kind of something to put on our radar here. I think this is the last macroeconomic data. The In April, nearly 29% of price data was estimated, twice the typical rate. Okay, because I think the survey responses are coming down. Reveals staffing shortages. So we're also seeing, we have stagflation data coming, but we're also the reliability of data is decreasing due to a federal hiring freeze. So this is kind of concerning. Okay, let's move on. Oh, I want to cover this too. On real estate, which we just discussed, construction industry. This is one of the reasons why I think construction employment has turned down actually here, and it's going to accelerate downward in the coming months. The US home purchase applications gauge declines to a 5-week low. US mortgage applications for home purchase declined to a 5-week low, even as rates eased from the highest levels since January. So this is now happening even as rates ease because the employment market is softening. People aren't going to go out there buying homes when they're worried about their jobs. The Mortgage Bank Association index of applications for home purchase decreased to 4.4% to 155 in the week ended May 30th, which included Memorial Day holiday. The contract rate on the 30-year mortgage fell 6 basis points to 6.92%, according to data released Wednesday. Now, automotive industry, Tesla. This came out yesterday, and is one of the reasons why I think Tesla stock is overpriced. And I think this is a piece of news that Tesla bulls should pay attention to. I don't think people are feeling ready to switch to EVs, okay? Or pull the plug on their gasoline cars or hybrids, so to speak. Despite wider availability of EVs across the US, interest among potential buyers has waned, according to the new AAA research. The latest EV consumer survey showed 16% of US adults being very likely or likely to purchase a fully electric vehicle as their next car, the lowest percentage recorded of EV interest since 2019. That's massive. Okay, this is a massive revelation. I think, as I've said before, hybrids are top of mind for most buyers, and Toyota has really been taking advantage of people's range anxiety. Additionally, more than half of those surveyed, 63%, also reporting being unlikely or very unlikely to purchase an EV, the highest level since 2022. Electric cars still represent a growing market for the auto industry, said Todd Berger, Chief Automotive Officer. AAA is committed to working with automakers to ensure we deliver outstanding service no matter what. Interest in EVs was high in 2022 when nationwide gas prices pushed above $5. In that year's survey, 77% cited gas savings as their top motivation to purchase an EV. And as we know, oil prices have crashed since then, and gas prices are now down to about $3. Top reasons survey buyers say they are less likely to buy an EV include high battery repair costs, high purchase price, concern for long distance travel, lack of convenient public charging stations, fear of running out of charge while driving. Okay, so range anxiety is most of this. All right, let's move on. Tesla May sales fall in big European markets ahead of the new Model Y deliveries. Model Y deliveries have started, and Tesla is actually offering very attractive financing rates across Europe for the new Model Y, and just a couple of months after it started production, which is, if that doesn't say demand issues, I don't know what does. Tesla sales dropped for the fifth straight month in Britain, Germany, and Italy in May, underscoring the challenges the EV maker faces over CEO Elon Musk's politics in its model lineup. Demand for the company's new version of the Model Y, Europe's best-selling car as recently as 2023, will boost sales in June when UK deliveries start, a British company spokesperson said. Well, UK isn't as big of a market as Germany, but let's see what happens. Tesla sales have plunged in some European markets and China as customers have favored Chinese EVs because of their competitive prices and in some cases in protest at Musk's political activities. So the protest against Musk's political activities is more European, okay? Because I estimate, like as far as I know, Europe is like one big California in terms of their politics, very left. But in China, so the politics can change. Like let's say tomorrow Elon woke up and says something like, "You know what? I am as left as you can get. I'm going to change my gender and use pronouns." He might get some of these leftist sales back, okay? But in China, the competitive pressures are really intense and they're only intensifying. And I don't see how Tesla is going to be able to keep up with that. And I'm going to show you in a little bit what's happening with China sales. In Norway, however, the new Model Y, which the automaker has already started delivering there, has boosted sales. Deliveries of the revamped EV start this month in a number of other European markets. In an email sent to some media outlets late on Tuesday, a spokesman for Tesla in Britain said the decline in May sales was because the automaker had sold its stock of old Model Y cars as it awaited the new version of its factory in Berlin. I don't think that's correct. Um, this article doesn't seem up to par. Let me show you. We talked about this yesterday. China's Xiaomi founder expects EV business to turn profitable in H2. Okay. This is the critical piece that I think is missing from Tesla Bull's understanding of what's happening in China. Okay. Tesla, just like other EV makers, was riding the wave of accelerating EV adoption across the country. The biggest automotive market in the world is China, and EV percentage of sales was rising very rapidly. But now that's been saturated. Okay, it's not that's not going to increase as much anymore in the future. We're kind of at the upper end. China is kind of like the upper end of the S curve when it comes to EV adoption. So now um, Tesla is going to struggle. Tesla needs to take market share from other automakers. But BYD and Xiaomi are now producing vehicles that are better than Tesla in terms of their range, charging speed, some of the technology, and also they appeal more to the consumer taste around buttons and everything. And they're selling them at half the price. Like BYD vehicles are half the price of Tesla's vehicles in China. And Tesla's price in China actually the lowest across the world in terms of their own prices. So despite that, despite Tesla's margin being zero to negative in some of their products they sell in China, like the Model 3, um, Tesla is now starting to lose market share at a saturated market. So you're seeing the sales decline. Tesla China sales drop year to date period from 2023 to 2024. You saw it drop from 232,000 to 224,000. And now it's accelerating this year. In 2025, year to date, down to 209,000. I think it's my forecast that 2026 will be down again. And that 2027, 2028, until Tesla exits China. A lot of global automakers are exiting the market because they can't keep up with the Chinese automakers. And I suspect that's what's going to happen to Tesla as well. So when you see this table going around by Tesla Chan on X, when you see this table going around, instead of focus on weekly data, focus on this year-to-date number. I focus on this year-to-date number. And I suspect we're going to continue to see the declines accelerate in the coming weeks, in the coming quarters and years in China. All right. Let me see if there are any questions, comments. On that note, thank you very much, everybody. And I will chat with you all tomorrow, which may be a little later than usual, but I'll tweet it out and take care.